Today is going to be a pretty packed show. I've got a lot to talk about. I'm going to take you through a bit of a portfolio update and talk about how my style of investing has evolved over the past year and where I see my investing going in the future. I've also got a friend with a dilemma, and you guys have been helping me out decide what he's going to do with the spare bit of money that he's got. And then I want to finally take you through all the aspects of my portfolio, show you what I've been investing in, what I've got rid of. And we'll have a look at Bitcoin as well, because Bitcoin is very, very interesting at the moment. But first, I want to take you through a little theory of mine, which I'm kind of coining modern dividend investing.
I'm amazed how many people own stocks. I'm amazed how many people own stocks.
Welcome back, everyone. My name's Paul. I'm brand new to investing. I've been investing about a year, and to be honest with you, a lot of people say that I'm not brand new to investing anymore, but really I am. In comparison to people who've really been investing for a long time, those guys really don't consider themselves above novice level until they're about 10 years in. So I consider myself extremely new to this still, and I am learning as much as I can all the time. The purpose of this channel is really to share new things that I learn every single week. I'm also going to make an absolute ton of mistakes, so you can look back on these videos, and if you're new to investing and you're watching this in like 2030 or whatever, you can go, oh, that Briscoe, he was full of shit. And that's okay. The beauty of me having a YouTube channel is I get to talk to lots of different people. I get to talk to lots of people here in the comments, and I get to talk to lots of other people in the Discord. And we all have really varying views on exactly what investing is about. A lot of people love growth investing. A lot of people love dividend investing. A lot of people love something in between. And that's perfectly fine. But what seems to be the case is that whatever camp you're in, wherever you get your information from about what type of investing you might need to be doing, you tend to stay very convicted to either side. It's either, oh my God, growth investing is the best thing ever and you shouldn't be doing anything else. And with dividends, it's often like, oh, that company cut its dividend, we've got to sell it. I don't think it is all that simple. I started with the dividend investment strategy because I found it as the most reasonable investment strategy that kind of stood out to me. I get how to do this. And initially, I think dividend investing and dividend growth investing is very good for this when you're starting out. If you're doing it correctly, you're essentially buying really good, high quality companies that do capital appreciate and pay quite a lot of a dividend. It's kind of like going to a bowling alley and just putting up the bumper guards the first time, and it just helps you get down the right path and actually knock over some pins in the short term. But what happened in 2020 was there was no gutters. Everyone out there, including myself, was just knocking full strikes out. And that's caused a lot of people to just generally become geniuses. It's currently a new paradigm. There's no other way to make money than growth. And that's okay. You're allowed to think that. I don't think you're wrong because you think that. Dividend investing did start out for me as this sort of safety net. I can put into lots of high quality companies, and I just know they're high quality companies because I know the names, they're blue chip stocks. And those companies will continue to capital appreciate, and the more money that I put into these companies and the more dividends that I reinvest, the more money I'll get over a long period of years. This is dividend compounding at its most basic. I've still got no doubt in my mind that this is a safer and less risky way to make money in the stock market. And index fund investing, if you can keep your head on, is even safer. I started investing in November 2019, something like that, and I started investing in speculative growth. I learned very quickly it wasn't for me. And then I moved to what I now call traditional dividend investing. Now, when I think of a business, I think of a business as having one real goal, and that's to return cash to its owners. If I was to start up my own wedding photography business, the whole point of that would be to pay my bills. And that's how I see a business. And when you're buying shares of a company, you become the owner of that company. And therefore, I feel like you're entitled to a slice of that pie. When you're growth investing, you're getting in there early and you're trying to get that value before the dividends start getting paid. And when those dividends start getting paid, I assume you sell the stock and then those dividends all start going to somebody else, someone like me. And then what you'll do, you'll rinse and repeat. You'll find the next big 10x company and continue on that way. And we've got this idea now that with traditional dividend investing, because sometimes they just start to decay and die over a long period of time, that it doesn't really work. It's like if a growth company decides to start paying a dividend, that all of a sudden starts to make it weak because it's not reinvesting all of its profits and all of its cash back into the business to help it grow. There's this idea that dividends just take away from a company and don't give anything back, which again isn't really true. And that's before we start to mention that if we start creating a culture where we scare companies into not paying share buybacks and not paying back dividends, then we end up in a system where companies are forced to reinvest all of their money back into the business, even though they have got too much money or they don't know where to invest it. That's just going to force a never-ending cycle of really poor reinvestment. And not all companies need to continue reinvesting. Like Visa. Visa has a profit margin of 52%. There is no way in the world that Visa can spend all of its money all the time. So what it does is it gives back to shareholders in the forms of dividends, in the forms of buybacks. But of course, there's absolutely no doubt that there are companies out there that are struggling to keep up its dividend payment. There's companies out there like IBM at the moment that are continually losing money and still continuing to try and give back their dividend to shareholders. They fear that if they cut this dividend, their share price will drop dramatically. And it will, because apparently that's what dividend investing does. So I think it's time to move on from traditional dividend investing. You know, the type of investing where we just look for a high yield and then we just try and buy as much of it in order to get as much back. Because I don't think that's the best way to look at businesses. But what I'm trying to say here is that I do think dividend investing does work if you're the right sort of person. In the same way that growth investing works if you're that sort of person. What I think we can all agree on these days is that traditional dividend investing, you know, the type where you just buy into any old company for the high yield, that doesn't really work. And now that I'm a year in, I've developed a couple of new rules, new categories or new criteria that I'm looking to follow going into 2021. I start off with the basics of investing. Like I said last week, building a base, emotional control, and knowing your risk. I always forget that third one. Building a base is me constantly investing into the market as much as I can in general and really trying to increase my savings rate. Number 2 is emotional control. And emotional control generally comes down to the style and conviction of what stocks you're buying. Usually most people can control their emotions by buying into an index fund and setting and forget. And all they've got to do really is tell themselves that the indexes always go up, which to a point they always have. And if you're interested in learning about that, I mean, you can watch more of my videos coming in the future because I'm going to go into market psychology so much more in the future. I think it's one of the most important things that you can do when investing. But also Morgan Housel has a book called The Psychology of Money. It's absolutely excellent. I've put a link to it in the description below. It's in the books link or something. Get it on audiobook or something. Sign up to Audible. It's brilliant. It really opens up your mind to where most people lose money in the stock market. And finally, I need to know my risk. And I mediate my risk and I mediate my emotion by dividend investing. Dividend investing is a style that speaks to me. I understand it. I understand the compounding. And that's how I want to proceed. But I don't want to lose money while I'm investing. I've invested in growth. I've got a full growth portfolio here in my invest account. This is like where I get the free shares from everybody signing up for Trading 212 in the link below. And in this portfolio, I do a lot of swing trading to practice. I do a lot of technical analysis to practice that as well. And I also invest in a lot of the famous small cap companies that kind of everyone is talking about, just to see how they're really going. Because a lot of people on YouTube seem to be making absolutely crazy money by following these small cap growth stocks. But when I've actually put it into practice with this investment account, I'm finding that I'm in the red everywhere. This is why I don't growth invest. But I also did hold companies like McDonald's and Coca-Cola, and I still hold Pepsi. And these are traditional dividend growth companies which aren't doing very well at the moment. And I think modern dividend investing is just so much more than trying to pick an old oil company and hoping that it keeps its yield up. I'm personally going to stay with a dividend investment strategy, but I'm not just going to accept that these companies are going to be around forever and they're going to stay relevant forever. I'm not just going to buy McDonald's because I think, oh yeah, there's one on every corner. Dividend and dividend compounding still makes sense to me. Dividend growth makes sense to me as well. It definitely will make me sleep a little bit better knowing that I'm making money for doing absolutely nothing. But I think with modern dividend investing, we just need to be a little bit more picky. So here it is, my criteria for going forward with modern dividend investing. First, I'm buying the dividend of the future. So I'm looking for companies that are growing their dividend at quite a considerable rate. Microsoft is a really good example of this. It tends to grow its dividend at about 10% per year. And here on Fast Graphs, it's showing a compound annual growth rate of 12%, which is pretty good dividend growth. I know that my dividends are growing 12% a year without me having to do anything. I'm also trying to find companies at the correct point in their corporate life cycle. The traditional corporate life cycle has an initial launch phase, which can take a number of years. It took Amazon, Apple, Microsoft well over 15 years to get through this launch phase. 15 years is a long time. Then we end up with its exponential growth phase. This is apparently where Tesla is sitting right now, right at the bottom of this exponential growth phase. So we could see a massive increase in earnings from Tesla over the next couple of years. I have no ability of guessing when these companies are about to do this. And unfortunately, that's why growth investing is not for me. But we eventually get to mature growth, and that's where companies start paying dividends and share buyback. Google, Facebook, and Apple are very good examples of companies that are going into their mature growth phase. They're generating so much cash that they are really struggling to find places to put it. And if they make too many acquisitions and become too much of a monopoly, they all eventually get broken up by the antitrust. So these companies need to be very careful with where they need to reinvest their money. It's not that they can't figure out anything to do with their money. It's that they've just got too much. And eventually, that should come back to shareholders. And Google, Apple, and Facebook aren't new companies, and they've got plenty of growth to go. So what I'm saying with companies like Square and Tesla, if they really are going to 4 trillion, I can wait. I've got plenty of time to see if this pans out. I don't need to get in there early. I really have no FOMO in this situation. So personally, I'm trying to find companies toward the end of this exponential growth cycle and then more into the maturity and hopefully missing out on the decline part. Because that's the bit where you hear about those value traps. That's the part where we start picking yield over quality of business. And third and probably most important is that we're not giving up capital appreciation. These companies that are paying out their dividends need to lose less in a crash, but also appreciate in a bull market. And on top of that, we need to couple it with a high margin of safety. Broadcom is an excellent example of this, still relatively undervalued in my opinion. This company is seeing ridiculous capital appreciation, and it's going up in tandem with its own free cash flow, and it's continually growing its dividend as well. It's one of those companies that has a really good high dividend, but is also really capital appreciating at the same time. I want to find a mature company that is still relevant and is still reinvesting for the future. Visa, Microsoft, Broadcom, KLA, AT&T are all companies that are reinvesting heavily into tailwind markets. They're choosing to innovate rather than being forced to innovate. Like, I don't fully get why Square bought Tidal. There doesn't seem a need for it to do that. But Square needed some interesting news. It already spaffed a load of money on Bitcoin. It needed to make an acquisition to show that it was growing. Second rule for me is that the dividend growth needs to be high, but not constant. Companies are allowed to cut and preferably freeze their dividend if it's going to help them grow. And I know that's pretty hard for people to get their head around, but Disney is also included in this. Disney recently cut or paused its dividend because of something that wasn't really its fault. Disney is a company that has been crushed during the pandemic, but because it had these ideas of innovating into streaming, it cut its dividend to allow itself to continue to grow. Companies should be allowed to do this, and when you do look into modern dividend investing style companies like Lennar, which has cut its dividend many times, but this was generally because of things in the market that they didn't really have control of. As shareholders and owners of these companies, we should understand this and we should allow the dividend to be cut because we know in the future it's going to benefit us. I just don't understand why people don't get this. Third, these companies need extremely high cash generation. Visa has a profit margin of 52% and it grows its company by complete organic growth. Visa doesn't really need to reinvest into different parts of fintech. It grows organically based on the amount of new people that want to buy stuff. Simple as that. But Visa has realized what the future looks like and it has decided to reinvest into crypto and digital wallets. Number 4, yield doesn't matter. What? You heard me, yield does not matter. It doesn't matter how much these companies are paying back to you. It could be 0.5%, 1%, 6%. As long as it's all covered by the cash flow, it's perfectly fine. As long as these companies are giving something back to the shareholder, it's perfectly fine. And again, I'll point this out. This is for me. My aim is to see these dividends grow. I'm investing in my income of the future, not my income now. I'm hoping that when I'm 45 or 50, these dividend payments have been growing like 10% a year, or in Visa's case, 37% compounding. I'm hoping that in the future, these dividend payments are going to be much, much bigger, and I won't have paid a lot of money for them. And lastly, I need to buy at the right price. I can't be buying these companies at ridiculously high valuations. McDonald's appears to be one that's so stupidly overvalued just because of its name. It's losing revenue year on year and trades at a ridiculously high multiple of 35 PE. Wow, that is crazy. It's trading at such a high multiple because people think it's safe. I certainly don't think there's a risk of them cutting their dividend anytime soon. But remember, that's not a reason to buy a dividend paying company. Okay, I bet that made absolutely no sense to people. I'm trying my best to convey a point there, and I think I've just rambled on for about half an hour. I'll definitely try and refine this modern dividend investing theory as we go on over the next year. And I'll try and do this, and I'll try and apply this system as much as I can to how I run my portfolio. Now, I put this question up a week ago on my community tab, and thank you to so many people who voted on this. 2,200 votes is absolutely incredible. And this is quite a large amount of people who voted on this and pretty much decided how my friend was going to spend their money. So my friend definitely has £10,000 just spare, but he has a mortgage of 180 grand and he has a car loan of 10 grand. And I asked the community, you lovely people on YouTube, what would be the best thing to do with this money? Because personally, I racked myself for weeks about this one to figure out exactly what the best move is. Because a lot of people talk about getting rid of debt as the most important thing. Mathematically, I worked it out. With the car loan, I'd save 480 quid. With the mortgage, I'd save a total of 1,800 and something. But that would be over 10 years. And the car loan, obviously, I save the 480 quid straight away. And if I put it in the market for 20 years, based on an interest rate of 4% year on year, I could possibly end up with £4,802. So the math here definitely points towards the market. And there were so many good comments that came with this. There were so many people thinking about different ways that this money could be used. People definitely did the math, and we found that overall, that mathematically putting it in the market was definitely the best way. But a lot of you, and I thought this was very, very interesting, 55% of people found that paying off the car loan, no matter how much money it actually saved, would actually be the better option. Because this is the junction we always talk about between psychology and mathematics. Which one is much better for you in real terms? And it seems that the majority of people who watch this channel, or at least have interactions with this channel, think that paying off the car loan is more important. And I think all of these people agree that this would not earn any more money than bashing it in the market. So I said to myself, because I thought these three options were pretty much negligible, I figured there was no real difference between the three. I'd let you guys decide. And last week I decided to pay off my car loan, which had about £10,000 left on it. We found a small lump sum of money, so we decided to make our lives easier by paying off the car loan. I'm still not 100% sure if it was the right idea, but now our monthly wallets are 270 quid heavier, which could just go back towards the market. Again, mathematically, it doesn't work out. I get it. I could have easily earned 4 grand off that money by bashing it into an index fund. But the thing is, to me, if I had bashed it in the market, I would still be obligated to pay 270 quid a month into this car loan. And what I'm trying to do right now is try and make myself a little bit more free and try and make the family a little bit more free to be able to spend that money or put it into the market when we want to. We're even thinking that the extra 270 quid a month could just go towards paying off the mortgage. We think that's probably going to be a really good idea as well. So thank you to everybody who took part in this. I read all of your comments. I took in all of the information that I could. And eventually we decided to pay off the car loan. Right, onto the portfolio. Oh, this is going to be a long one. My dividend investment portfolio sits at 23,343. This has really appreciated recently in the past couple of weeks as we've seen this shift from tech to value. AT&T has been holding itself up above 30 consistently, which we haven't seen in years. Who knew AT&T was potentially going to be a big winner in 2021? Mad. Overall though, my portfolio is mostly in the green and I'm absolutely loving it. And I know a lot of people have recently been in tech and seen quite considerable losses. That's okay though. I don't see this going on forever. This is not designed to be the type of portfolio that wins in all situations. It's supposed to just win in these awkward times in the market. In a couple of years, I'm sure growth portfolios are going to pick up much, much further than mine will. That's okay. And I'm currently sitting about 15% up, I think, which is far, far more than I thought I would be sitting up at this point in time. I'm also about 2% ahead of the S&P 500, which is nice. I didn't expect that to be happening, but I'll take it, no problem. What I will say though is my dividend payments haven't been growing as much as I thought they would. Particularly this month in March, I thought it would be a lot better than it is. I can't tell why these dividend payments in March are so low. You expect them to go in these little peaks and troughs of 3 months because that's how dividends are generally paid. They're generally paid quarterly. But I must admit, I have been putting a lot more into UK stocks recently, particularly UK dividend stocks like Legal & General, which only pay twice a year. And when you've got quite a significant amount of money in your biannual dividend payments, that might be a reason why the overall dividend payments haven't been so high recently. Still, it's always on an upward trend, and it should be. This is very slow growth. We're getting in the business of growing slowly. So hopefully over the next year, we'll start to see some real considerable dividend growth as I start to add more and more to my portfolio. In total last year, it looks like I gained £295 in dividend payments, which doesn't sound like a lot, and it shouldn't be for the first year. Like I said earlier, I'm having a little bit of a shuffle round. I've got AT&T here. I've got no intentions of selling AT&T. In fact, as soon as I can get it under $27 again, and I'm sure it will be there pretty soon, I'm just going to continue to add more. The thing with any form of investor, whether you're a growth investor or a value investor, you shouldn't really want your stock to go up immediately. You kind of do want it to trade sideways for a while, because in that time you can slowly build up your position until eventually there's some sort of catalyst that makes the company start to grow again. With AT&T, this might be HBO Max. Once we start to see some really good HBO Max numbers, and it is starting to see those numbers, it is starting to change the narrative slightly. That's why we have seen this move up from about $27 to $30 in AT&T. Once we see that, we might start to see a capital appreciation of maybe $40, something like that. And on top of that, you're getting your 7% dividend. So things look really bright for AT&T in my opinion. KLA has also been one of the massive winners of the semiconductor space. This week, the news from Intel that they're building 2 new factories in the middle of Arizona, I think it is. This has made companies like KLA and ASML, companies that provide pretty much all of the equipment to Intel for it to work. These companies have seen a massive capital appreciation recently, 24% up on the last 3 months. God, I wish I had ASML. You would not believe how much I wanted ASML. This is real FOMO opportunity cost. This is a company in which I knew in April 2020, I knew exactly where this company was going. I knew exactly what it was going to do, and I didn't buy it. I cannot believe it. It's the same with Broadcom, but I think Broadcom is still slightly undervalued, so I'm happy to keep spending more on this company. I don't think I can go much more into this right now because I'm knackered. I promise in the next coming weeks, I will go through the entire portfolio. I'll do one of those, my entire portfolio reveal, and I'll talk about it then. In the meantime, there is a link in the description below to my Trading 212 shared pie. That's where you can look at everything that's inside this pie, and you can see all of my holdings and how I prepare to weight them, or how I would like to weight them. Finally, I wanted to have a quick look at crypto. I buy my cryptocurrencies on eToro specifically because I think I'm trading it at the moment rather than keeping it. I don't actually see a reason why I would want to keep Bitcoin at the moment. because ultimately I think it's going to be a store of value, and that means it's always going to be around, ready to trade. I also say every single week that a lot of this is down to simple, stupid human behavior, and it's quite obvious, and I think that's why you can track it so well with technical analysis. And what you can see with this technical analysis is exactly where people want to buy and sell. This is the stupid human behavior part. And what we've done is we've reached this line of resistance, and currently this line of resistance is being tested. What we're hoping here is this green candle eventually extends through here, retests this line, which is now called support, and then runs off to all-time highs. That's what we're hoping. But mostly human behavior is pretty unpredictable. That's why we end up with all these wavy lines. All we're trying to find out here with all these straight lines is where the next price point might be. If Bitcoin crashes, it's very likely that it will come down to here at about 50,000 first, before then deciding whether it's going to go back up or come back down to sort of 38,000 could be the next real bad point. But that's not what the Bitcoin bulls think is going to happen. On the last 4 cycles, this is how Bitcoin has played out. In all of the halvings, we've seen these massive, massive spikes up. And at the moment, this is where we are in the cycle right now. This is the bet on stupid human behavior that I'm making. Between 1 and 2 years in, Bitcoin goes on a massive, massive run. But always what we see after that is a huge 70% plus pullback. So based on history, over the next couple of months, Bitcoin could easily go to 400,000. It's very, very possible that this could happen, but it's going to happen very, very quickly as well. It's going to happen over the course of maybe 1 to 2 months, maybe around September, August time, something like that. It will be all about timing at this point. That's going to be my plan now, and that's how I see Bitcoin going forward. By the way, this is just for me. This is in no way advice. This is exactly what I'm doing with Bitcoin at the moment. I was going to hold it, and if I completely miss all of this, I'm happy to hold Bitcoin for the long term. But I'd rather make a bit of money and time it back down if I could. It's worth noting here that I'm doing this with 1% of my money, and I'm willing to do this as a quick trade, and I know the risks that I'm taking to get into this. If anything that I've said to you right now resonates with you, and you think that Bitcoin is now going to go to 400,000 before jumping back down, and you think you can time it, you might not be able to. So please consider your risk, please consider how much you're getting into, and please believe me, I am not encouraging you to do this. This is a stupid risk that I'm taking with a very small amount of my net worth. Thank you very much for watching, guys. The investment app that I use is called Trading 212. If you wanted to get into investing, you can sign up through a link in the description below. If you sign up through that link, you can get a free share that's worth up to £100. I also get a free share as well. Also, I buy my Bitcoin and I'm trading Bitcoin. You can actually buy underlying asset Bitcoin on eToro. You can then transfer it out to an eToro wallet, and then from there you can transfer it out to any wallet that you want if you really want your Bitcoin. I'd still probably say that something like Binance is better to buy actual physical Bitcoin. But if you wanted to sign up to eToro and join the fun in there, you can sign up through a link in the description below. It really helps out the channel if you sign up through that link. Because I'm waiting for my first dividend. Once that comes in and I know Trading 212 is up to its word, then I'll probably start to look a little bit more towards the dividend investing side of things. We'll see. I'm not 100% convinced, and it seems like a bit of a fad at the moment. Particularly, there's all sorts of stuff coming. There's going to be a crash and stuff. I could lose all my money tomorrow. If the stock market crashes tomorrow, then I'll be quids in, really, because I'll lose a lot of money now, but over time it'll all come back. So that's where I'm at. I don't know where it's going to go. We'll see what happens. Until the next video.
I'm amazed how many people own stocks. I'm amazed how many people own stocks.